Hello and welcome to Chapter 6. Source Documents. Part of Practical Bookkeeping Theory. Brought to you by the Association of Practical Accounts, APA.
Hi, my name is Kate, together with Paul, to take you through this chapter. We only appear on this slide, but we'll be talking to you through the whole chapter. To get the best from us, we request for silence and maximum attention. However, if there is anything not clear, please replay the slide or video as many times as you want. We wish you all a good learning session.
Chapter Overview. 6.1. Introduction is on Slide 4. 6.2. A receipt is on Slide 11. 6.3. A check is on Slide 19. 6.4. A deposit slip is on Slide 27. 6.5. Payment voucher is on Slide 30. 6.6. An invoice is on Slide 34. 6.7. A debit note is on Slide 42. 6.8. A credit note is on Slide 46. 6.9. Statement of account is on Slide 50.
Section 6.1. Introduction. A source document is a paper which provides information about a transaction that took place. It's prepared as the transaction takes place, and it's the source of information we record in bookkeeping.
This document provides evidence that a transaction took place, and it's also referred to as a supporting document. It confirms that the transaction actually took place. Documents include receipts, till slips, invoices, debit notes, credit notes, bank and credit card statements, check stubs, deposit slips, and others.
All the information we record in bookkeeping should come from a document. Therefore, all transactions should have a document supporting them. Exceptions are accepted for journal adjustments. However, the description or narration should have fairly sufficient information.
In case of year-end adjustments like prepayments, they are supported by documents as well. There should be a sufficient explanation to support an accrual.
When there's need for further clarification about a transaction, we check the document indicated in the reference number column. This is often done by tax officials and auditors.
It's a legal requirement that all source documents are stored for 6 years after the end of the financial year. This implies they may be required by tax officials within that period, for verification or investigation purposes. Next is an illustration of 11 documents we normally use in bookkeeping.
These are the source documents we normally use in bookkeeping. They are 1. Receipt. 2. Invoice. 3. Check and stub. 4. Deposit slip. 5. Payment voucher. 6. Debit note. 7. Credit note. 8. Statement of account. 9. Bank statement. 10. Loan statement. 11. Credit card statement.
Section 6.2. A receipt. This is a document prepared when a seller receives payment from a buyer. It confirms and proves that payment was made by the buyer, or that the seller received the payment. Next is an illustration.
This is a receipt illustration.
The details of the receiver are written or printed at the top. It has space for the date, the one who paid money, what it was paid for, and the amount. It also indicates whether it was received in cash or check form, plus space for the check number.
The one who received the payment prepares the receipt. The original or top copy is issued to the one who paid. What remains in the receipt book is the duplicate copy, which serves as the source document for received payment. This is filed on the Income and Receipts file, as explained in the following chapter.
When the business makes a payment, it gets the original or top copy of the receipt. This is filed on the Purchases and Payments file. So we can recognize the difference between a receipt received for payment and the one issued by the business to support a payment received. What is a receipt issued by a seller, turns out to be a receipt received to a buyer.
Till slips. Preparing a receipt may be a long process, depending on how many cash transactions the business makes. This process has been speeded up by till machines that are common in supermarkets. The item sold is identified by pressing a button, or the machine scans the information. It has the date already set, and it picks up all the required information from its database storage.
Once it's informed that the transaction is complete, it quickly generates the totals, accepts the paid amount, calculates the balance, and quickly prints out the slip. The information contained on a till slip is not much different from a handwritten receipt. As source documents for bookkeeping, they are treated in exactly the same way.
Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. We have more information to share with you. Thanks.
Section 6.3. A check. This is a document used to withdraw money from a bank current account. It instructs the bank to pay a particular amount to the one written on it. The bank to pay is printed at the top of the check. The name of the account holder is printed at the bottom right. It has space for the date, the one being paid, the amount paid in words and figures, plus a signature for the account holder.
On the left-hand side is the check stub or counterfoil. Below is an illustration.
Section B above is the actual check we tear out of the checkbook and give to the one being paid. Section A is referred to as the check stub or counterfoil. It has space for the date and the one being paid. There is space to enable the account holder to update their records. The balance brought forward is the closing balance after the previous check, or the balance before this check.
We add any deposits after that to get a new balance. Other debits is for any money removed from the account that we are aware of. These are deducted together with the value on the current check to get the closing balance that is carried forward.
Parties to a check are the people or institutions affected by a check, and they are a drawer, a drawee and a payee. A drawer is the one who draws and signs a check. They own the money on the bank account and they are the one paying using the check. It may be a business like ShopRite, an individual, or an institution like a school.
A drawee is the bank where the money is deposited, and it's the one instructed to pay the money on the check. Examples are Standard Bank, Barclays Bank, First National Bank, Stanbic Bank, and others.
A payee is the one who receives the money indicated on the check, or the one being paid. If an individual withdraws money from their own bank account, then they are both the drawer and payee. Please identify the parties on the check filled in above.
The actual check issued to a payee serves as a source document for their money received. The check stub, which remains in the checkbook, serves as a source document to the drawer. However, the drawer may also receive a receipt from the payee, indicating it was received in check form, plus the check number. Any of the two can serve as a source document, but we use only one. Using both leads to duplication, yet the payment was made only once.
Section 6.4. A deposit slip. To deposit is to take money to the bank. A deposit slip is a document we fill in when we take cash and cheques to the bank. When the bank receives it, it stamps to confirm it received the money. This document is also known as a pay-in slip. So the source document for money deposited on a bank account is the stamped deposit slip.
Below is an illustration.
The bank, where money is deposited, is printed at the top. It has space for the name and account number, where the money is to be recorded. It has space for the different cheques and the different denominations of cash being deposited. Lastly, there is space for the one depositing to sign.
Section 6.5. Payment voucher. This is a document prepared before a payment is authorized. An invoice or a quotation for what is being paid for is attached and checked before authorizing and signing the voucher. If payment is made using cash, then a petty cash voucher is prepared. If payment is by check, then a bank payment voucher is prepared. Or it may be combined into a payment voucher as illustrated next.
This is a payment voucher.
Each voucher has a number that differentiates it from the others. It has space for the date, the detail of expenditure, the amount paid, and the expense account to be charged. Both the person authorizing the payment and the person receiving the cash have to sign.
These vouchers or their copies remain in the business to prove that payment was authorized by the right signature. However, since a voucher is internally generated, it does not support an expense. It should be an externally generated receipt or invoice to support an expense, to be allowed for tax purposes.
Section 6.6. An invoice. An invoice is a document issued by a seller to a buyer when goods are sold on credit. Next is a sample.
This is an invoice.
It has the name of the seller and their contact details, plus its number printed on. The date, name of buyer, quantity, description, price of items, plus total value of items are just filled in. Some of them indicate the period in which the payment should be made. In this case, it's strictly 30 days after the date on the invoice.
It contains an abbreviation ENOE, meaning errors and omissions accepted. This gives the seller the right to correct an equal error arising from the omission of an item or an incorrect addition.
When a business sells on credit, it issues the original top copy to the buyer, and it retains a copy. This is also known as a sales invoice. When a business buys on credit, it receives the original top copy of the invoice. This is also known as a purchases invoice.
So the source document for credit sales is the copy of the invoice issued sales invoice, while the source document for credit purchases is the invoice received purchases invoice. An invoice issued by a seller turns out to be an invoice received to a buyer.
Proforma invoice. It is a document sent by a seller to a buyer when asking for payment in advance. This is sent when the seller does not want to sell to the buyer on credit. This is equivalent to a cash transaction.
Hi, we thank you for your cooperation through the past slides. We hope you are gaining some knowledge in the process. Please remember to note down anything important or requires clarification. You may discuss with a colleague, an accountant, or a tutor nearby. Your next option is attending our free online tutorials, where you ask any questions. Your last resort is sending an email to admin@practicalaccounts.com. If you need to have a break, just press the pause button. Otherwise, we keep firing on all cylinders. All we need is your silence and undivided attention. We have more information to share with you. Thanks.
Section 6.7. A debit note. A debit note is a document sent by a seller to a credit buyer when there was an undercharge on a previous invoice. An undercharge is when the amount charged is less than what it was supposed to be.
It could be due to a mistake in the calculations, writing a lower amount than the actual price, or omission of an item on the invoice. This undercharge can also be corrected by sending another invoice.
Below is an illustration for a debit note.
This is only used in circumstances of credit transactions. The business issues a debit note to its buyers or debtors to increase what they owe. The business also receives a debit note from its suppliers or creditors.
Section 6.8. A credit note. This is a document sent by a seller to a credit buyer, aimed at reducing the amount indicated on a previous invoice. The amount is reduced because the buyer had been overcharged, or they returned some of the goods bought. An overcharge is an error, where a buyer is charged more than what they should pay.
Below is a credit note.
Most documents increase the debt, but since this one reduces it, it's often printed in red to reduce the chances of confusing it with others.
This is only used in circumstances of credit transactions. The business issues a credit note to its buyers or debtors to reduce what they owe. The business also receives a credit note from its suppliers or creditors.
Section 6.9. A statement of account. This is a document sent by a seller to a debtor, showing transactions which took place between them in the previous month, and also serves as a reminder for payment. Next is an illustration.
This is a statement of account.
It's a summary of the transactions which took place in the last 1 month. In the details column is recorded the nature of transaction or source document and its number in the reference column. In the debit column is recorded the amounts on invoices. In the credit column are the credit note values and the payments made.
The last is the balance column, where the balance brought down from the previous period is recorded. A balance is calculated after each and every transaction is recorded. An entry in the debit column increases the balance, while an entry in the credit column reduces the balance.
This statement is actually a copy of a debtor's account in the debtor's ledger. So the debtor uses it to check the accuracy of their records, by comparing its contents with those on the particular creditor's account. If the closing balances are not the same, then they should find out why. The business sends out statements to its debtors, and it also receives statements from its creditors.
Other source documents include bank statements, loan agreement, credit card statements, wage computations, plus others. These are explained in later chapters.
After getting to the end of this chapter, please test yourself by attempting the multiple-choice questions in the textbook. For better exam preparation, do further reading in your textbook. If you don't have a copy, please contact admin@practicalaccounts.com. The end, and thank you for your attention. We hope you enjoyed this chapter. Brought to you by the Association of Practical Accounts APA.